Thanks for tuning in to Talking Point. I'm your host, Neelkanth Shah. India at 75. Our special coverage continues with some of the best minds around all spheres of business, economy, and markets. And somebody who probably combines all of these with aplomb is Neelkanth Mishra. He's our special guest today. Neelkanth, great having you. Thanks for joining in.
Thank you for having me on your show.
No, the pleasure is ours. Neelkanth, no investing or business landscape over the last 3 years, at least, if not forever, is devoid of uncertainties. How do you assess the current landscape in light of the fact that geopolitics is well and truly here, entrenched, and not looking like going away in a hurry?
Absolutely. And I think that most investors tend to be neutral on geopolitics, and which creates downside risks for the market. And what I mean by neutral is, like, whenever you're doing some modeling, you tend to assume that the thing that you don't understand will not change, right? So if you're doing, finding with what variables you should use for modeling a company or some macro, you assume that, look, this I don't understand, so let's assume nothing changes. And that's the reason why I think that most people are neutral on geopolitics. But the risk then is that something happens that surprises us. And there are experts, senior ministers, diplomats, ex-diplomats, whose take on the current situation is that this is a slow, long crisis, that this is not a blink and you miss it crisis. So this is something that will remain an overhang on the economies and the markets for a while. And that could actually be an overhang for the markets as well. And I think that the risks are not yet fully priced into the markets.
So because there are many facets, I started off with this particular thing instead of asking you a broad brush. Can I first take a leaf out of your answer and then maybe ask in some of the other questions that I have? So when you mentioned that there are risks to various facets arising out of this geopolitical scenario or quagmire that we are in, what is it that you're referring to? Where is it that you think the market is not taking full cognizance of the extent of the impact of the risk?
Right. So there is a generic comment and there is a specific comment. So let me start with a generic comment. The generic comment is, in the last 20, 25, maybe 30 years, we have become used to the state, right? And I mean the state meaning the governing infrastructure in the countries, having a responsibility to grow the economy. So we almost assume that the responsibility of the state is to grow the economy. In the last 3 years, since COVID started, or maybe a couple of years before that, we have started to see that that is not true. The first priority of the state is self-preservation, which is why the lockdowns during COVID were, of course, to prevent public health disasters, but also to prevent uncertainty, because when you have chaos, the state structures dwindle, and then suddenly a new regime can come in place. And that chaos or resistance to that chaos is the reason why lockdowns were imposed. Similarly, as we see regimes focusing on security, or not just immediate security, but future security, it is about the states negotiating power structures. And that means that economic growth is not first priority. Right? And that's a big change that has happened. And when senior experts say that this is a slow, long crisis, my fear is that it will not go away very quickly. On a very specific level, what this means is that you see restrictions on critical resources. So energy and civilization are very tightly linked. And underneath, and so if you keep drilling down, so you start with cars, then you go down to, okay, so you need rolled steel, then you go down to, okay, you need hot rolled steel, and then you need blast furnaces. But at the core of most supply chains is labor and energy. The moment you start restricting energy or restricting some critical inputs, you are deliberately slowing down the global economy. And what that means is that the aggregate output growth can actually be quite constrained. And so over and above the fact that the more you trade, there is more efficiency. It may hurt individuals or groups in specific countries, but overall it helps the collective humanity. And all of those assumptions and all of those trends are now reversing. The assumptions are now have to be questioned, and that's something that worries me. That we are not yet fully assuming or not yet fully factoring into the markets. Now, that is not to say that there will not be opportunities. So even if the peaks in some of the markets may not be revisited for quite a while, there will be bounces that last 6 months and 9 months, and there will be sectors that can outperform. There will be sectors that will underperform. So there will still be opportunity. There will be enough to do in the markets, but this is an overhang which I don't think will go away for a while.
Okay. Sorry, just so that I don't miss out, this was the generic comment, or this combined both the generic and the specific piece?
So no, this was should have been part of the generic comment. So the specific is mostly on energy and access to materials, and in some cases access to technology. Right. So if you limit access to technology for to large groups of people, or certain technology to large groups of people, you are creating inefficiencies, right? And I'm not saying that those are unjustified, that the states have their own mandates and their own longer term objectives, but the fact that these technology access is now going to be restricted, the fact that countries will try to create nearshoring, friendshoring and all of that, these are economically inefficient decisions, and these create downside risk to earnings and corporate earnings.
So Neelkanth, do you sense that the base case could well be a paradigm shift in how one, valuations could be, and two, how the behavior of the state could be, in that growth need not be a given in the scheme of things?
Absolutely. So the growth is not the first priority. Now, it is clear that as the inflation risks sort of recede a bit, and suppose unemployment goes up again, politically tackling unemployment will become a political priority, right? So it will be a priority of the state, and that's where I think policy making becomes a lot trickier than it is right now. I mean, right now it is just about targeting inflation, but I think in 6 months' time, it will be balancing, okay, what level of inflation are you okay with? But that paradigm shift, I think, and these are cycles, I think, for the next, maybe in the foreseeable future, or let's say in our markets, foreseeable future is actually a very short term. But the fear I have, and I think it's something to worry about, is that the cost of equity, right? So what you use to discount future cash flows, and that underlies the price to earnings ratios that you and I discussed. Cost of equity, there is a risk-free rate and there is an equity risk premium, right? Putting very simply. And the risk-free rate, which we had gotten used to at, say, a 2% over the last 3 years, is perhaps now going to be 3%. For a while, right? And of course, eventually, the five-year in the US is still pricing in 2%. So hopefully, we'll get back to that level. But that 3% means that the risk-free rate itself has gone up. So the price to earnings multiples that we should expect should be lower. Then there is the equity risk premium. The equity risk premium encompasses all types of risk to equity, right? So geopolitical risks, macroeconomic risks, some risks of macroeconomic accidents, and so the ERP needs to be a bit higher than it was, say, before 2018-19, and that encompasses all the things that we discussed earlier, right? The risks to availability of energy, and therefore lower growth, uncertainty in policy, right? So you will see, because there is no clear direction, and there will be political changes. So if you see periods of grave uncertainty, geopolitical uncertainty and macroeconomic uncertainty in the past 100, 120 years, in democratically elected governments, there are there is uncertainty as to who's the leader, right? And leadership keeps changing. So elections and failing governments and re-elections and all of that. And therefore, the identification of what the collective wants is something that is not as straightforward, and it takes time. And that period of uncertainty itself is a risk. And this is why ERP can be higher than it was before 2018.
So in a scenario like this, Neelkanth, could fixed income or a perception of fixed income become a lot more dearer than what it was in the preceding decade? And in that, while debt was a forgotten entity, maybe so to say 2010 to 20, could debt be the meaningful core of a portfolio for the, as you said, the foreseeable future, as short as the foreseeable future maybe?
That would be, I mean, I can understand why you're asking the question, but let's overlay on that two further points. The first is that globally, debt as an asset class, debt securities are many, many more times larger than equities, right? So it's the fact that some money may shift from equities to debt or something is not going to really move the needle on the debt side. From an individual perspective, I mean, so irrespective of what's happening globally in terms of asset allocation, is there a decision to be made for individual households, for individual portfolios? And I must say that the markets are reasonably efficient in the sense that the fact that we are seeing dollar strength, right? So the DXY is so strong is a reflection of the fact that risk appetite globally is very low, right? So people do not want to be in Europe. People for a while did not want to be in Japan, though we think that there could be an opportunity in Japan. People did not want to be in emerging markets. If you see the last 5 years, even in equities, almost all the returns have come from the US equity markets.
Yes.
And so all of these factors are showing that the markets are kind of already concerned about this, and some of this actually could be priced in. But to your question on individual sort of asset allocation at a household level, I would think that eschewing risk, at least for the next 6-9 months, given where markets are priced in and the recent bounce that we've had, would be a prudent thing to do.
You would have been asked this question innumerable number of times, Neelkanth, about the premium that India enjoys vis-a-vis rest of the world. The question is, in a world which is as fragmented, in a world which is looking eastward, looking for options beyond China, and forget just the late China plus one argument, but even otherwise, and the fact that India remains, give or take, the fastest growing large economy in the world, so to say, is that premium likely to continue with the kind of growth that you anticipate India to deliver vis-a-vis the rest of the world, or are there some pulls and pressures around it?
No, I think that I mean, at least in my view, that premium should sustain. I am not convinced that that premium can expand further, right? So there is I mean, it is already very high. Remember that I said almost all the returns over the last 5 years has come from the US. Actually, the only other market which has delivered good returns is India. And unlike the US, where the returns have been driven by earnings growth, in India, quite a bit of the returns have been driven by PE expansion, which I think anticipates or reflects some of the positive momentum in India. There are many reasons why I think India should be an integral part of global portfolios, and the price to earnings premium should sustain. The first is that, plain and simple, and we have discussed this often on your show as well, that the real estate cycle, I think, is turning. And I think an economy the size of India, without the real estate market doing well, it is very hard to grow, right? Because as households, if you just think about how much you spend on food, how much you spend on housing, multiply that by on real estate or in clothing, and then you multiply that by 30, And then you think about for your requirements, the house how expensive it is, right? And not just Bombay, right? Think about Bangalore, think about Delhi. And it's the largest purchase. And so the real estate market is turning. I think the much bigger change is that private profits have become much more acceptable than they were, say, a few years back, right? For most of India's history, the regime was suspicious of foreign capital. It was suspicious of private capital. If you see, since 1990, the acceptance of foreign capital has improved, right? So there are governments across political parties which with pride say that this is how much foreign investment we've attracted, right? So the suspicion of foreign capital has gone, which is a good thing. I think we need that expertise because it comes with a lot of knowledge as well. Acceptance of private profits is something that also, I think the regimes, and again, across states, states are competing for business, right? So they are attracting, they're giving more and more incentives. So I think all of these are very positive signs for the sustainability of India's growth. And in this period of uncertainty, I mean, the very fact that large global consultancies, I mean, they come to India and their CEO writes, if there is one reason to be hopeful about the future of the world, this is the place to be, right? And which makes me worried about the market because, if everyone is convinced that this is the king, so that's why I think the P premium will not expand most likely, but I do expect it to sustain.
The two bugbears, Neelkanth, and quick thoughts. Sorry, so we've taken 15 minutes. Do you have 5 more for us?
Yeah, sure, of course.
Okay, great. So the twin problems, one, if energy is going to be, in your words as well, at a premium, if you will, if I understood you correctly, right? And that kind of hurts India, plus the fact that it feeds into the twin deficit problem that India has, and the first sign of global vulnerability for a global investor. India, amongst other markets, would also be a one to get out of immediately. So how does how do we tackle this, if you will, either naturally or through the course of some policy moves that can be done? I mean, I know this biogas, etc., is all happening, but a hydrogen fuel is a dream, right? I mean, unless technology can really make a breakthrough. So what do we do until then?
Oh, great point. And I should have added this caveat to my previous the response to your previous question, that we import 48% of our dense energy needs, right? And that's a huge vulnerability. So if globally energy is going to remain expensive, that's a big drag on growth. Like, just to give you perspective, we have net invisibles exports, or net services exports, of about $165 billion. Capital inflows, give and take, once things stabilize, $85 to $100 billion. So $250 to $265 billion of goods trade deficit we can sustain with a balance of payments which is stable. The moment it goes beyond that, and remember that July trade deficit, for various one-off reasons as well, was as high as $390 billion if you annualized it, right? So there is a huge gap in terms of sustaining those imports. If you adjust for lower oil prices, if you adjust for lower palm oil prices, if you adjust for the fact that there was some restocking of oil that happened, that 390 falls to $290, $300 billion. Now, that is still a $35, $40 billion gap that we need to bridge. And I think this is going to be a challenge from the near-term perspective, right? So we need to go through that adjustment. That may mean a weaker rupee, that may mean slightly higher rates than would have been necessary if we were focusing just on domestic inflation. But that's a headwind to growth. And you're absolutely right. That's something we need to worry about, not just in the next 6 months as we correct for that. And hopefully, if there is normalization of at least supplies, right? So the fears of disruption in February have receded, which is why oil prices have come off. But remember that China is not fully open yet. So there is a very large part of the Chinese economy which is still, they're seeing activity restrictions. So their oil demand can still go up. But if oil prices remain at $90, $95 Brent, I think there is less of a risk. At 120, I think there is a big adjustment that needs to happen. On a structural basis, see, the hydrogen, etc., I think will take 10 years to get corrected. But we need to be we need to be cognizant that this is also an opportunity for us in the sense that the new investments that are needed to create the energy infrastructure for India are going to be and remember that things like the new electricity bill, right? It is not just about the energy that we import; it's also about how do we use the energy. So, if in India, industrial power tariffs are among the highest in the world, and residential power tariffs are among the lowest in the world, that is a driver of inefficient use of energy, right? And economies like Japan, when they first saw this challenge in the 70s, have gone to an extreme. In fact, the every dollar of GDP that you can generate out of imported energy is among the highest in Japan. And I think that there is significant opportunity to improve that. But I do think that despite these headwinds, a 7% kind of a real growth over the next 3 to 5 years seems quite likely for India.
So therefore, last two questions, Neelkanth. One is, and the last one is on private markets, the whole startup ecosystem, and how enthused are you with that? But before that, on the public markets, do you sense that, I heard you mention in your opening answer that while there might be a near-term cap, if you will, on what the markets do, they don't visit their highs, etc. There would be specific opportunities, themes, etc. Are there constructive arguments for secular growth over the course of the next 3 to 5 years within sectors which may do well irrespective of what the headline numbers on the markets do?
I think there are sectors like that. So I think that it may not be every real estate company in India, but when a cycle turns in real estate, I think it lasts several years. This is not generally a 3-6 months turnaround, and I think that area could provide opportunities. It does not mean that you go and buy every real estate company, because generally those are micro markets. There are different demand supply dynamics. There are corporate governance issues, and there are many other things. I also think that construction infrastructure will pick up. There is, as someone said, 80% of the infrastructure that India needs in 2047 hasn't been built yet. The financiers of that, I think, will be, so we are still overweight financials. In the near term, of course, in the next 6 to 9 months, we are trying to hide. We are trying to find places. So we have picked up domestic pharma, some utilities, some staples companies to sort of hunker down in. But if I was thinking 3 to 5 years, I think infrastructure, financials, I would say even some of the personal vehicle manufacturers, where supplies have been constrained over the last 3-4 years. And I think a recovery there could actually, we are seeing stronger order books. Some of those themes have actually started to play out already. So all of these would be areas that I would be positive on. On the private market, there is a structural angle, and there is, I would say, a near-term angle. So in the sense that, remember that India has a problem of too many entrepreneurs with too little capital, right? And small entrepreneurs. So it's very hard to create a system where they get risk capital, they get loans, because banks struggle with issuing loans of ticket sizes 1 lakh, 50,000, 2 lakhs. Similarly, getting equity capital of 10 lakhs, 20 lakhs, for historical reasons, has been a huge problem. What the boom of the last 10 years has done it has created angel investing networks in many cities. It's not just Bombay, Delhi. It's actually in Indore and Jaipur. There are angel investing networks everywhere. The creation of that pipe, or those pipes, is a very, very important part of the future of India. Remember that till the year 2000, venture capital was purely a US phenomenon, and I would say even a US West Coast phenomenon. It then shifted to China, then in the last decade has moved to India, Latin America. And this form of capital actually is very potent, especially for poor economies where per capita wealth is low, and that plumbing has historically been an issue. Having said that, given how the first wave of unicorn listings have performed, I think the adjustment of the valuations, because private market was effectively operating in a vacuum, right? And it's an inefficient market because there is no trading, liquidity is low, so pricing tends to get distorted. And while many people are saying that this is a death knell for private investment, I don't think so. I think this is an important correction. Some people will bear losses. Some people will have burnt their hands. Some firms may actually disappear. But from a medium-term perspective, I think it's a very healthy development that we are going through right now. So in the next 6 to 9 months, maybe 12 months, maybe 15 months, I think things will be a bit subdued. But this development is actually a huge positive for the Indian economy.
So cool talking to you. Neelkanth Mishra, thank you so much for your time. As always, really appreciate this conversation.
Thank you, Neelaj. Thank you for having me.
And viewers, thanks for tuning in.